Hey, everybody. Thank you for joining today. We have a lot of information to go through. The markets have been pretty interesting. We got to all-time high. We have a lot going on politically and also in the tax landscape. And we will actually be spending a little bit of time talking about taxes here at the end. So make sure that you stay tuned for that. As far as today, we're going to cover everything with some updates on tariffs. We're going to talk about the stock market. We're going to jump into the inflation outlook. And then we're also going to, like I mentioned, cover the tax part. So the first and probably biggest part here is the date to watch has shifted from July 9th to August 1st, was when we were supposed to have tariffs reintroduced after that 90-day pause. That's now being moved to August 1st. And there is a lot of action going on in between now and that being implemented. Namely, actually, just earlier this week, President Trump released some of the tariff rates, right? And some changes. On the right here, we can see that we have some impacts to our largest trading partners. And this is the part that's a little concerning here. Canada, we had a 0% rate in April due to essentially just the path of where negotiations are going. Canada, Mexico, and the European Union are seeing some pretty big increases, right? Canada and Mexico from 0% all the way up to 35 and 30, and the European Union from 20 to 30%. Now, when we raise tariffs on them, they will probably counteract and also levy some against us, which will contribute towards some of these inflationary numbers that we're going to talk about just a little bit later. Additionally, there was just a very interesting one here with Brazil, a huge increase from 10 to 50%. And I think that the stock market, essentially, especially in the past couple of months, has really taken off under hopes that tariffs were not going to be essentially as big of a thing. But we're seeing right now that this isn't in the past, right? This is still something that we need to be focused on and looking at what these impacts will be. So where we are right now in the market is we're kind of at a defining moment, right? We're at a point very similar to a few past market upswings that we've had. And what we've seen here essentially is that we could go one of two ways, right? We could either break higher from here or we could break a bit lower and then kind of move at the same level, right? Move laterally or horizontally without much real movement in the market. And it could go either way. So you don't want to be too defensive in your portfolio, but the way things are looking, it might not be as favorable here in the short term. Now, when we look at the average return in the stock market, in the S&P 500, and we look at the monthly performance. Now, there are a lot of charts that I was able to kind of pick from to explain this. And I chose the one here with the past 20 years performance. Now, there are some other great charts that go back throughout history to the early 1900s or even 1950. And one of the main items which is highlighted here is that September has been historically the worst performing month of the year. And what that means is, this negative 1% here is if we take all the Septembers over the past 20 years, how the S&P 500 or C-Fund did, and we average those all together, we have a negative return. Now, there's a few other months in the past 20 years that have been negative, namely August, June, and February. But if we were to go to a longer term time frame, we'll see that February is a little negative. August, the average return is normally close to 0%, but September is still that really big down month around 1%. So one thing that we should consider when it comes to your accounts, your investments, one of the things is that we are currently at all-time highs in the stock market, and we are about to enter what would be the worst 2-month period of the calendar year. And ironically, this just happens to fall at the same time that these tariffs are supposed to go back into effect, right, on August 1st to kick us off, if you will, for this 2-month period. So when it comes to portfolio and risk, that's something that we're keeping in mind. Any of you on the line or who watch this recording, who are my clients, I'm already making the appropriate steps with your portfolios for this. Anybody who is not, when it comes to your TSP, 401k, IRAs, accounts, this is something that you're going to want to take into account. The end of the year is the strongest quarter, right? October, November, December. So if you're concerned about shifting things around or you're not sure what to do, you are actually in this case better off to do nothing, right? It might go down a little bit in the next couple months, but then it should come right back towards the end of the year, assuming that these averages play out. But we are not expecting, based off of forecasts for the market end, we're not expecting to see a huge difference in the market. I do think we might go up a little higher because of a lot of the extra stimulus pumped into the market from the Federal Reserve, from also the new tax bill, which we're going to talk about. That's going to increase money, right? That's increasing our debt, but that's also increasing money in supply because it's lowering taxes. From here, we have also seen a shift in a good direction, right? So not all of this is bad news. And I think that's really the main idea here is like to share both ends of the spectrum, right? What are some of the bad things or things to be concerned or aware about? So if we look at the balance of the stock market, and I'd like to highlight right here back in April. All right. So in April, the percentage of stocks or companies in the S&P 500 who were going up in value, right? They were trending upwards. It was only 29.4%, right? So less than a third. And 70% of those companies were in a downtrend, right? Prior to that market downturn, right, that we had in April and May, we previously, back in February, we had 50% of companies in an uptrend and basically 50 in a downtrend. Now, the other part here, of course, this math doesn't add up here, is going to be companies that were essentially in neither. And previous to this, while we had a very strong market in 2024, we had 80% of companies in an uptrend, right? That's why we saw the accounts, right, and the values go up so well. It's because most companies were growing to some degree. Now, the good news I have is that after this 2-month downturn, we are now at a point at the end of last month where we have 60% of companies in an uptrend. So we're in better shape from that perspective than we were back in the beginning of the year, back in February. At that point, we had 50. So we have more companies who are growing. It's not all falling on our big tech companies, right? NVIDIA, Amazon, Google, Apple. It's not all falling on them, but we have a much more significant amount of the market going up. They're in an uptrend. The other part here is that we don't, at the current time, really think that these big tech companies are really going to pull back. If we look at the forecast of their earnings, is that we are still seeing them projected to perform twice as well as the other 493 companies in the S&P 500. So we're still seeing a lot of growth and momentum, but it is slowing down in comparison to what it was over the past few, 2-3 years. So let's take a look at that. So here's the projection, right, for the next couple quarters. So the orange here is the S&P 500 earnings growth year over year, excluding the Mag 7. Again, that's the Apple, Amazon, Facebook, Tesla, NVIDIA. It's excluding those 7. Now, the blue here is those 7. So we can see that the blue and orange bars are a lot closer together now. This past quarter, you'll actually notice that excluding the Mag 7, the market actually did nothing. It actually was negative this past quarter. Q1 and prior, there is a significant difference, right, in the blue and the orange bars here. In other words, if you were not in the Mag 7, you missed out, right? And well, a lot of us think, hey, it shouldn't be that sustainable for these 7 companies to really carry that weight of the market. It has, and it's because we've had essentially an explosive amount of growth and speculation in artificial intelligence and what that means for the future. So that is the main contributor. But what we're starting to see is the pricing, the value of these tech companies has really factored in now where people are starting to see, hey, there's opportunity elsewhere, or hey, it might not be that sustainable for these companies to keep growing, potentially even at these rates. So we're starting to see a more level playing field, and that means diversification into other areas of the market. The other 493, the Russell 2000 or S Fund, some of your small and medium sized companies as well. We should see other areas starting to provide more growth, not just having all this money in the big tech companies. Another area that has been a silver lining this year, and actually I would say part of last year as well, is international. And international has actually outperformed the US stock market, especially this year, by more than double. Now, that depends, of course, on which funds you're looking at. But if we're just looking at, let's say, a very broad index like the S&P 500 compared to the MSCI EFI, there's a big difference. When it comes to this, international does still have room to run. And what I mean by that is when we look at the PE ratio, the price to earnings, this is how we judge how overvalued or undervalued a stock or a index might be. And the international index, we're at 16 and a half times. So when we compare these valuations, international is essentially undervalued right now. And maybe it might be fairly valued, but the US is definitely priced a lot higher. So these international companies could still carry on. And if we look through the long history of the stock market, there are short pockets of time where international does better than US. That is why advisors will diversify a portfolio, right? They'll have some money in international, small companies, medium companies, large companies. And it's because different areas do better at different times. Now we happen to be in a period of time where international is really performing well and the large companies are performing well, but smaller and medium companies have been struggling a little bit more. And a lot of that has to do with interest rates. When interest rates are high, smaller companies don't perform as well or medium because they're the kind of companies who take more loans to build a new product, to have a new marketing strategy, right? More social media ads, etc. That comes with essentially a higher cost that they might not have that cash on hand. So they will take a loan to leverage to try to grow their company quicker. When debt is more expensive, they either might not be taking those loans or because of that higher cost, it's eating into their profit margins. So that's why we see smaller and medium struggle a little bit more when we have these higher rates, which if rates go down, however, that means those are going to be some of those companies that will really benefit from that change. For right now, large and international have really taken over the show. Speaking of tariffs from earlier, the inflation numbers have actually ticked higher in June. So we just got the reading out from June and it showed a very slight tick up in CPI, right? Now, core CPI took a zero point 0.1 increase. So it was just very nominal, but we saw basically the first impact from tariffs. Now, if you look at tariffs and actually a lot of economic data, it takes about 6 months for it to properly show up, to really see the effect. It takes typically about 6 months, sometimes even a little bit longer. So we have seen the first, just barely scratching the surface, the first tick up due to tariffs. So what this means is over the next 2-3 months, we might see that tick even higher. In other words, maybe Jerome Powell is not so crazy to be saying, hey, no, we don't want to cut interest rates yet. We want to see the impact of these tariffs first because nobody completely, I mean, they can forecast, right? But they don't know exactly how impactful these tariffs are going to be, let alone the fact that they keep changing. As we talked about right in the beginning, how a lot of these different tariffs are going to be increased and those counter tariffs are going to increase our cost of goods. So until we see the full impact, we really shouldn't expect interest rates to really switch and come down. My impression, while they say there might be 2 rate cuts this year, I think it's going to more so delay into next year. I think this whole tariff thing is going to go on and on this year as we try to negotiate, and we probably don't see any interest rate cuts, which means the smaller and medium companies might have a harder time this year. Not that they won't grow, but maybe not as much. And we will probably not see the bond market really pick up and take off until they start to cut rates as well. Now, bonds on the flip side do pretty well as long as rates are stable. So I wouldn't be too concerned about that. But the first impact of tariffs is essentially finally starting to show into inflation. And this is going to be something that in the next 2-3 months, we want to keep a very close eye on because this will also contribute or dictate what happens in the stock market. Remember I said August and September aren't normally very strong months. If we also have rising inflation during that, that can also be a contributing factor to the market's performance. Now, again, it's not all bad news. The treasury yield curve could steepen, right? And we are looking at it steepening right now. And essentially, we don't like when this curve is down. So when we fall below zero here on this chart, this is typically a indicator of a recession. And the good news that we have is, at least what it appears, is that we don't have a recession yet. At least they haven't officially labeled it as one, though maybe a couple or a few years ago that was questionable. But we have come back above zero and we are working our way back up to a comfortable level here at 100. 100 being more like that longer term average. So as long as we see this treasury yield curve come up here, this indicator at least is showing, hey, we might actually be avoiding a recession here. So that is a great piece of news. It's something we'll continue to look at. But the fact that we've moved away from zero and came back up above in the positive is a great sign. Now, I've gotten some questions from clients. Should I go put money in a different currency? The US dollar might be down a little bit right now, but it is not out. And in fact, we are kind of right in the same range for the past about 4 years that we've been in. And we are at a key level right now, which is called a support. So, a support, we've talked a few times about this technical analysis term, is essentially a level where you tend to, let's call it bounce off of it, right? Kind of picture like a trampoline. So, picture if you were to fall backwards and somebody caught you and you fall again and they catch you again and also push you back up. You're going to build a lot of confidence that, hey, if I fall backwards, right, to this certain level, if I fall so many degrees backwards, I will be caught and pushed back up. And that is what is happening here with a support. Each time the market comes close to, or in this case, the dollar comes close to a support and gets pushed back up, our confidence that this support is very strong increases. Now, the more times we touch the support, though, the weaker it gets. In other words, going with that analogy, if you keep falling backwards, the person catching you might get a little tired at some point. So we don't want to touch it too much, but every time we touch it, they get more tired or it gets weaker. So we need to see the dollar pick back up. Now, while there is some concern about the dollar in comparison to a lot of the other currencies out there, I'd say almost all, the dollar is really a resilient area that other countries will invest in US treasuries and things to essentially provide a stability of value. The US dollar, in comparison to most other currencies, has really maintained its value or actually even increased it, especially in relation to other currencies. In short, we're at this support, which is a key level. We just need to see it kind of bounce back up a little bit, and we should be back in good shape. Now, speaking of the Federal Reserve and everything going on here with the interest payments and inflation, the federal interest payments are getting dangerously high. So if we look at how much of our taxpayer dollars are going to paying interest on our debt, our national debt, which is done through the Federal Reserve and government issuing treasuries, whether it's to US citizens or even a lot of countries abroad invest in this, but we are getting dangerously high. We can especially see that here over the past couple of years, 2023, 2024, and honestly here into 2025 as well. And the issue is we have high interest rates and we will periodically need to refinance this debt, issue new treasuries to pay off old treasuries. And with higher interest rates, that means we have to pay a higher amount. So that's why we're actually seeing this making up a bigger portion of our national debt each year. The other parts would be Social Security, Medicare, Medicaid, which I'm sure a lot of you might be familiar. There were a lot of cuts to Medicaid here recently with this new tax bill. So if this number keeps pushing up, we will have to cut in other places or tax people more. So the story here is going to be that we need to take advantage now of the low rates. These are essentially made permanent, but we all know that that just means in the future, they could be changed. Another administration can come in and change this. So while they are low, we should be really taking advantage, because the way that this debt is looking is that we're at some very high levels. We haven't been at these kind of levels since the 90s. Now, let's talk about the big, beautiful bill. or one big, beautiful bill. My opinion is this is short term, let's say a good thing for a lot of people, but not so much for the country. The anticipation of this increasing our national debt by 3.4 trillion over the next 10 years is a scary feat, especially given how high our national debt already is. But if we look at what this is doing, we are making the 2017 tax provisions permanent. There's going to be some new deductions for overtime where there will be essentially no tax on that under certain thresholds or ranges. And that's going to be for the next 4 years. There are some increases to the estate tax limits, the SALT, state and local income tax and property tax deduction, and itemized deductions. Now, the SALT one is very interesting because for anybody who lives in a higher tax state, like, say, California or New York, where you have high property tax and you have higher state tax, that might be especially helpful for you. That went from 10,000 to 40,000. So that's a huge increase. Trump accounts were created. It's a nice little way to kind of kickstart somebody. It's $1,000 the government contributes, and then the parents can contribute up to 5K a year towards those accounts for kids. That is going to start next year. So anybody born, I believe it's after January 1st, 2026, they will get that account. Expanded the use of 529 and HSA funds. There's also some more limitations on student loans as well. Something to definitely keep an eye out for if you have kids approaching college age where they're not quite there yet, but they're approaching. Energy credit rollbacks and EV cuts, federal benefits, specifically Medicaid in this circumstance, and increased federal spending and deficit impact. So a lot more information we actually have up. If you haven't seen the blog post on our website, make sure you check that out. That's fedwiseadvisors.com. And there is going to be a little bit more detail about each of these, what they do. So make sure you check that out. There is one part, though, of that I would like to emphasize, and that is the Social Security aspect. These changes are not what you may think. So it was essentially advertised, if you will, that this big, beautiful bill is going to not tax your Social Security. And while that might be true for, I think it was 80 or 90% of Americans, it is circumstantial. It depends on your income. If your income is below a certain threshold, but it's not so much as straightforward as saying, hey, your Social Security is not going to be taxed. It is individuals 65 and older can claim a $6,000 deduction if your income is 75K or less, or double these if you are a joint filer, right? So that'd be under 150K. Now, as federal employees who have a pension, or maybe you and your spouse even have a pension, it's going to be a lot easier for you to hit this threshold. Your pension plus your Social Security, and then further down the line, add in a required minimum distribution. So when you add all this income together, getting to that 150 or getting to that 75K isn't actually that difficult, which means a lot of that planning earlier in life, the Roth conversions, are going to be a lot more important now. And to me, this really changes a lot of the strategy with Roth conversions, because prior to this bill, for most people I would meet with, I would say, yeah, a Roth conversion is definitely going to be helpful for you. Here is why. Whereas in this case, we need to really take a step back. We need to really look into the retirement plan to see when are they taking Social Security, right? Because this could potentially influence that decision for when somebody should take Social Security. This might also influence the decision for when you do conversions, or if it might even make sense to do larger conversions before you take Social Security, so that when you do, you're able to get more or all of this deduction. This could even just shift the strategy where you're doing conversions, but you're converting a lot less each year. So as far as this goes, this has had a huge impact on tax planning strategies and also Social Security optimization for when you may enroll for. Now, one thing to mention is this bonus over 65 deduction is set to expire after 2028. So it might not even have enough time to impact you potentially. But again, just like with the Tax Cuts and Job Act, this could be extended. This could be made permanent. This could be extended for another 4 years or 8 years in the future. So it's something that we want to factor into our planning, but right now we don't want to completely bank on the fact that this is going to be here permanently when it could not. So a lot of thought and consideration to go into this one, but it does significantly change that landscape. For any of my clients, we'll be meeting here in the fall and we'll be rediscussing everything. And I will have a plan together for you for what we should do in your case. If this impacts when you take Social Security, if this impacts how much we're converting to Roth, or if we are, or if we should continue to. For those of you who are not clients, you can reach out. I'll be happy to have a sit down with you, kind of look at things together with you and give you my 2 cents on what you might do. Now, a few things to remember. All these monthly commentaries, just like the one today, are recorded. We then upload them to our YouTube channel after a few days after we get our compliance team to review it. We also have a monthly newsletter that launched last month. And then there's going to be a couple days that we're out next month where we're going to be going to LPL's Focus Conference, which is a big training conference that they have this year in San Diego. So if anybody has questions, there is a Q&A box. I will hang around for a little bit just in case there are any questions. Otherwise, thank you all for the time today. I appreciate you joining. For those of you watching this after the fact, I hope you enjoyed the video and hope to see you guys all in the next one. So I will just hang around here for a few minutes, just see if anybody has any questions. Otherwise, I hope you all have a great day. Hope your summer's gone well, and I will see you guys in August. Thanks, everybody. Take care.